from Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, except I think it's just the TV. I'm David Weston. Welcome to Balance of Power, where the world of politics meets the world of business. We start today, once again, with the markets, with stocks plummeting on trading on again and off again. We turned that into Taylor Riggs. So are we trading or not?
We are trading, yeah. So let me remind you, this morning we opened up down 10%, David, which meant we were open for about 30 seconds. The limit is 7%. We closed for 15 minutes and reopened. And surprisingly now, I'm going to call this a rebound. We're only off 7 or 8%, which is much better than 10 and 11%, which we saw earlier. But flip up the board for the month, it does not look good. We are down now 30% from our fresh record highs that we had really just a month ago, David. As you can see there, we're off 28, 30, 35% on all the major averages in just 1 month.
Boy, it's selling stocks but buying bonds, it looks like.
Yeah, there is a little bit of a bond rally. You can thank the Federal Reserve for some of that. You had the 10-year falling about 20 basis points or so. I think the 30-year is still hovering above 1%, which is a good thing. But they're launching QE, which, as we know, well, they're not calling it QE. We're going to call it QE. So you're getting a lot of rally, perhaps on the 10 and on the long end.
So let me put you on the spot, Taylor. A question that a lot of people are asking today. Is the market down because of the Fed or despite the Fed? Because some people are saying that some of the indications were the markets are going to be down a lot even before the Fed. And the Fed didn't make it worse. They just may not have made it that much better.
That's a good point. I think potentially the 2 emergency rate cuts made people wonder if the Fed knows something that we don't.
Yeah.
So the fact that they came out Sunday and knew something that they could have potentially waited 72 hours for, they couldn't even wait until Wednesday. They had to act Sunday night. That potentially made markets nervous. On the other hand, like you said, this is not a financial crisis. This is a medical crisis. And so markets arguably could have been down no matter what until we get that flattening out of the curve in terms of the number of cases.
That's what we're waiting for. Okay, thank you so much to Taylor Riggs. Thanks for being here. And for more on that emergency Fed rate cut late yesterday, we welcome now Joshua Younger. He's J.P. Morgan Head of U.S. Interest Rate Derivative Strategy. He's coming to us on the phone. So Joshua, thanks so much for being here. Let me pick up with where I was with Taylor. What's your take about the market reaction to that rate cut yesterday?
So on the equity side, like was mentioned, there's just a lot going on and there's a lot of uncertainty, and this is a very unpredictable thing. So like that, the market is down despite Fed action, from our perspective, is not necessarily surprising given the raft of uncertainties. The other thing to keep in mind is, because this is not a financial crisis, this is not a consumer spending issue necessarily related to interest rates. It's related to medical concerns. And so the fact that interest rates are lower don't necessarily, and hopefully shouldn't, affect people's willingness to actually go out and spend and go to stores and restaurants and things like that. It's really about a medical public health emergency.
Joshua, is it making the markets nervous at all that there's almost nothing left in the larder, so to speak, for the Federal Reserve? There's not much left for them to do, is there?
There's not that much. I mean, there's a speculation about negative interest rates, which the European experience suggests, certainly isn't all good news. There's a lot of debate as to whether or not that is the right way to go about it. With respect to the kind of non-traditional interventions that the Fed is doing, they certainly have more dry powder there. It was mentioned, should we call it QE or shouldn't we call it QE? I think the way to think about what the Fed is doing on liquidity is just a massive intervention to avoid this becoming a financial crisis. So the key here is let's keep this solely about economic growth and the broader implications, but we don't want accelerants in the form of instability in markets just because of the way they function. And in that sense, what they're doing is enormously helpful. And they're trying to alleviate these acute stress points that are really related to the ability of markets to price and intermediate risk and not about what the right level of that risk should be.
Yeah, and I take it that is part of the reason that they coordinated with other central banks on the dollar swaps to make sure there were dollars available. Yeah,
absolutely. I mean, the dollar is an international asset, and there are many, many, many borrowers of dollars that are not in the United States. They do it through a combination of venues, but one of them is the foreign exchange market. And so issues in the foreign exchange market, and specifically the short-dated FX funding markets, posting euros for collateral against dollar lending, for example, that's a critical part of global financial market infrastructure about the flows of capital. And what they're doing with foreign central banks is saying, look, we're here for you. if you need dollar funding, not at necessarily a great rate, but at least there's someone on the other side of the trade.
Joshua, I wonder if some of us may expect too much out of central banks, and particularly the Fed, in this sense. As you just suggested, what they've been doing basically is making sure that all the plumbing works properly, that the mechanics work properly, but they can't guarantee the underlying value of the assets. They can't underwrite basically the growth of the economy.
Oh, exactly. I mean, they can't guarantee the quality of assets, but in this case, we're not talking about credit. The difference between this and 2008 is in 2008, it was a collateral quality question. How much is this thing really worth at the end of the day? Whereas in this case, I mean, these are U.S. government bonds. We can talk about what inflation is going to be in 10 years, but at a minimum, you'll get your $100 back when the bond matures. The U.S. government prints the currency. So in that sense, it's less about the quality of the asset and more about just the quantity of it and the speed at which this unwind is happening. What we really want to avoid is a disorderly deleveraging, which was threatened in 2008, again, because there were all these leveraged positions where the collateral quality was at issue. How much is this collateral really worth? Here, there's just a lot of constraints on the ability of the market to process the quantity of collateral that's trying to flow through the system and as positions are squared.
So, Joshua, that certainly applies to U.S. Treasuries. I don't hear anybody suggesting the full faith and credit of the United States government is in question at all. So that's a very important point of the quality of the collateral. But there are a lot of other financial transactions where the quality of the collateral may come into question because there are a lot of companies that are going to be put under a lot of strain that have borrowed a fair amount of money.
Yeah, and this is where, again, the Fed can come in. One of the things that's been floated is a commercial paper funding facility similar to what we saw back around 2008. And the idea there is, in this case, because of competition among short-dated assets, when we think about the issues with Treasury bonds, they're artificially cheap, essentially. And so it's possible for short-term investors to source much higher returns from these very low-risk positions simply as a function of the fact that markets are not functioning properly, and that can siphon some capital away from credit markets. We started to see a little of that happening. The reason why that's important is because if corporates can't access capital markets to raise liquidity, they go to the banks because they have these credit lines, and there was very well-publicized draws on those credit lines, and now banks have a problem because they have a leverage issue themselves. If too much of this credit is drawn on, all of a sudden contingent liquidity is now actual commitments, and the size of that is potentially significant. So giving corporates access to capital markets is another classic case of central bank support for the plumbing the financial system, because these companies are trying to raise liquidity. They're not necessarily having credit issues themselves, at least at this point.
Joshua, you put your finger on it, the commercial paper issue, because some people thought they might act on that as well. They did not. Do you expect them to do that in their meeting later this week, or why did they do it now? Because as you suggested, we had that problem back in 2008, 2009.
Yeah, there was some allusion to it in the chair's comments at the press conference. Why now? Why not now and potentially later? I'm not entirely sure of the timing. I think at a minimum, setting up facilities like that and the details, which matter quite a bit, that's an involved process, and one would want to do that in a very deliberate way. So the way the Fed seems to be going about this is relieve the acute stress with tools they already have, which is asset purchases and repo funding, and then think about ways to alleviate the secondary stressors afterwards, but really focus on the acute pain points, at least in a quick and rapid and overwhelming way. When the Fed says they're going to offer $5 trillion worth of liquidity, that's not because they think the market needs it. That's them signaling this is essentially an unlimited supply of liquidity in exchange for good assets.
Well,
and these are assets that we know are money good.
Yeah, and interesting to your point, people didn't take down nearly the amount that was made available, actually, in that liquidity. As a practical matter, what's left for them to do this week?
So they're going to continue asset purchases. They've not committed to a schedule. So I think what they're going to do is every day assess how these operations go and see if they need to be bigger or smaller. And in the meantime, keep their eye on how the potential accelerants in the commercial paper market are functioning. Because if they can relieve stress in treasuries, they can reduce the risk that capital actually flows away from credit and into the treasury market. And so, it's really a process of trying something out, which in this case is massively upsizing asset purchases. For context, they're going to buy more treasuries today almost than they bought in a month during QE3. Right, so this is a very sizable intervention in the market. We could do it again tomorrow and the next day. They did it last Friday. So the key is to try these operations, see how well they work, see how the subscription rates evolve, because if they're oversubscribed, there's more wood to chop, and think about new facilities if those become necessary. But it's really an experimental process.
Okay, Joshua, thank you so very much for your time today. It's Joshua Younger. He's J.P. Morgan Head of U.S. Interest Rate Derivative Strategy. Coming up, Michelle Meyer of Bank of America is here to give us her take on what the damage is being done to the U.S. economy right now. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. I'm David Weston. Everyone seems agreed that there is real damage being done to the U.S. economy as it crashes to a halt in that effort to slow down the spread of the coronavirus. But how much is it being hurt, and how can we tell? We turn now to Michelle Meyer. She's Bank of America Chief U.S. Economist, coming to us today by Skype. So, Michelle, thank you so much for being with us. I don't expect you to have all the answers about exactly where we are, but how will we know?
So I think we have to take it day by day, minute by minute, and gather as much information as we can. So the first thing, of course, to try to understand is the spread of the virus. How quickly is it spreading? How many people may or may not get it? And when will that peak? And that is obviously a very hard thing to try to forecast, but to try to monitor it the best that we can. And then we have to think about what the precautionary response is, right? So the initial hit to the economy will actually come from the response of the government, of the private sector to try to stop that spread. The more draconian that response is, the more that the economy shuts down, presumably the better it is in the long run in that you stop the spread. But in the short term, it does mean more pain for the economy. So we're tracking right now for what's going to be a very weak second quarter, certainly negative, potentially deeply negative in Q2.
And Michelle, one of the issues here you just flagged is this sudden crash to a stop. We saw it in China. Actually, right now, red headlines crossing the Bloomberg that the European Union executive is proposing a ban on non-essential travel to the EU. So we saw it in China. We are seeing it right now in Europe. Did we learn anything from China? We got some China numbers out that, as I understand it, came in worse than we thought. Did we learn anything about what that might do to Europe and ultimately to the United States when you crash an economy to a stop?
Absolutely. We should certainly be looking at China. We should be looking at Europe. Europe is a few weeks ahead of us here in the U.S., and China's just over a month ahead. So yes, you should look at how businesses react, how GDP growth numbers come in, of course, consumers. But there is a very important distinction between the U.S. and China, and that's that the U.S. is much more services based. Our economy is much more dependent on services. China is much more dependent on manufacturing and goods. So in China, you can see how factories are shut down, and then they reopen, and you get a pretty fast, potentially a fast rebound in economic performance. That might not be the same story here in the U.S. because you need people to be able to come back out, engage in the economy, feel comfortable doing so. And if they didn't go out to restaurants the last few weeks, they're not necessarily going to make up for that in the coming weeks. So the fact that it's more services based means that it could be a little bit of a more painful recovery here in the U.S.
Yeah, a critically important point, it seems to me, because our economy has been sustained to such a large degree by the consumer, and obviously consumer confidence in spending money. Does that say something about maybe a lingering effect? This may take longer. This might not be a sharp V in the United States, at least, because of that question about consumer confidence and whether there's some residual dampening of that.
Absolutely. Yeah, I think it's a hard case to make for a V-shaped recovery. I think a U is still very possible, maybe a deep and prolonged U. So there is a recovery on the other side. Once we get the virus under control, people will be willing to go back out and engage in the economy to some extent, but it will probably take time. The other critical thing to monitor to understand the shape of this trajectory is the financial system, because what could be a shock to the economy as a result of the virus impinging economic performance could ultimately lead to a financial market crisis. And when you have a shock in the financial system, that amplifies whatever other shock you have to the real economy. And I think that's what the Fed is really, really sensitive to right now and trying to contain. They're trying to make sure the financial system is still up and running so that the recovery can take place when the time is right.
Michelle, there's a lot of talk about recession, whether we are inevitably headed for recession. Some people even suggest we might be in a recession right now. Does it matter right now whether we are technically in a recession, even as we speak?
I'm not sure it does, to be honest. I mean, I think what we can all agree on is that for the time being, the economy is going to be extremely weak. We're seeing a significant shift in terms of business behavior, consumer behavior, at unprecedented level, and it's global in nature. So yes, the economy is very weak. GDP is contracting as we speak. I think what matters more of whether or not we're currently in a recession is what will it look like after, right? So, can we start to shape this narrative that things will turn around, that the recovery is around the corner? Or is this something that's going to prove to be much more persistent and it'll be harder to generate that stronger economic growth? And again, I think a lot of that goes back to the policy response. If policymakers are forceful enough in offsetting the hit to the private economy, consumers not spending, businesses not investing, if the government sector can offset that and cushion that blow with automatic stabilizers and more direct payments to businesses and consumers, then I think the recovery becomes more likely. But really, to me, it's a big question of what happens on the policy front.
Yeah, when you talk about automatic stabilizers, you're talking about fiscal stimulus as a practical matter, and there's a lot of talk about fiscal stimulus. But given the size of the economy, at this point, would those have to be fairly massive to really get us back going again? At this point, I don't think we're talking about stopping the downturn. We're talking about really recovering as fast as we can.
That's exactly right. Yeah, there's not much you can do to stop it. The weakness is here and it's tangible. But yes, what you can do is try to get to the other side, try to get to that recovery, and it will be large. But look at what the central bank is doing. Look at what the Fed is doing. They're making it effectively free for the government to borrow right now. So slashing interest rates to zero, putting in place a lot of other measures to enhance liquidity and get credit flowing in the private sector, and presumably also supporting on the public side. You can see a coordinated action potentially between Treasury and the Fed, akin to what we saw in the 2008 great financial crisis. So yes, it will require a big response. It will require a large dollar amount, but financing right now is very cheap given what the Fed has engineered.
And that was the question, financing for what? How do you get the most bang for your buck, so to speak? Some people are saying, let's just give everybody in the country $1,000 across the board. Or do we target it more to specific areas in the economy?
So I personally think targeted response is going to be the most impactful. So, you could try to identify the parts of the economy that are getting hit the hardest. Leisure and hospitality, 70% of leisure and hospitality workers are hourly workers, which means that if restaurants are shutting down, if hotels are shutting down or not seeing the same amount of traffic, people are not going to be getting their paychecks. So to the extent that the government can either give those companies the ability to keep their doors open and pay their workers, or directly target those workers, that could be hugely impactful. Making sure that there's availability for funding, so supporting the banking system, supporting the smaller regional banks as well, making sure there's access to credit. So yes, I think that there's certainly policies that could be put in place that will be impactful, and I think targeted is what to focus on.
Okay, Michelle, thank you so very much. Always great to talk to you. Really appreciate your time. That's Michelle Meyer. She's Bank of America Chief U.S. Economist. Still ahead here, we're going to turn to Italy and the crisis over hospital beds with Professor Giacomo Grasselli of the University of Milan. This is Bloomberg. This is Balance of Power. I'm David Weston. We've all seen the video of the overextended hospitals in northern Italy. And now we're hearing that the Lombardy region may be seeing the lowest increase in the virus cases that is seen in a week. For more on what's happening in Italy right now and what we might learn from it, welcome now Dr. Giacomo Grasselli, professor at the University of Milan's Department of Pathophysiology. So, doctor, thank you so much for being with us. As I say, we just had a headline across from a different news organization saying that actually the virus cases in Lombardy are slowing down. Is that true?
Well, I hope so. I haven't seen the last numbers. Until yesterday, the numbers were still rising, probably a little bit slower than in the previous days. And this is somewhat expected because the complete lockdown of the region and of the country was about like 6-7 days ago. And you know that the usual incubation period is between 4 and 7 days. It can last for 14 days, but usually most of the people who are infected become symptomatic within 4 to 7 days. So we expected like a peak of the epidemic curve, like today or tomorrow, and then hopefully at least, if not an important decrease, at least a flattening of the curve, thanks to the containment measures that have been put in place. So yes, yesterday they told me that the number of new cases was not as high as expected compared to the previous days, And so hopefully this curve is like starting to flatten.
One of the concerns that we have increasingly here in the United States is whether we have enough hospital beds, and particularly intensive care unit beds, to deal with the crisis. Apparently in northern Italy, that's been a big challenge. What should we be doing right now, given your experience in Italy, what you learned about hospitalization and the need for hospitalization? What should we be doing right now to prepare ourselves?
Yeah, I know. Well, that's a big issue. Well, first of all, I have to say that the system in the United States, it's different from the system in Italy and in Europe in general, because usually in Europe, the number of ICU beds is a smaller percentage than the total number of beds, of hospital beds. So usually you have a higher number of ICU beds compared to the total number of beds. But despite this, the real point of this, the real issue is that, the number of beds you have is not so important in the sense that unless you're able to stop the spread of the disease or to contain the disease, the number of beds will never be enough. Because this disease is so contagious and the number of patients who require intensive care is so high that no healthcare system, no matter how powerful, organized, and modern it is, will ever be able to deal with this incredible number of patients who invest you like a tsunami, so a huge number of patients in a very limited period of time. To give you an idea, in Lombardy, 1 month ago, we had in the entire region 800 ICU beds, okay, for the entire region. Right. In the last 3 weeks, we have treated in our ICU 1,300 patients, and of them, like 300 are not there anymore. Some of them died, some have been discharged, and we now have like 980 patients currently being treated in the ICU. So we are already well beyond our previous capacity. So Lombardy is I would say quite a rich region. It's one of the richest regions in Europe. So we've been able to reorganize our system. So we've been able to increase our ICU bed capacity by about 50%. We have reorganized the network of time-dependent diseases in few hubs where those patients are concentrated. Right. And so this has allowed us to, until now, to grant an ICU bed to any candidate. Yeah. But the problem is that if it keeps going like this, sooner or later, and I'm afraid it will be sooner, the number of patients requiring ICU will be higher than the number of beds.
Doctor, thank you so very much. It's very helpful. That's Dr. Giacomo Grasselli. Coming up next, former Treasury Secretary Larry Summers will be joining us for his take on the crisis. This is Bloomberg. From New York, this is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for a check on those markets. Stocks are sinking no more than 8%. Actually, something like 5.5 or 6, I think, Haley. And Kaylee Lance is here to explain it to us. It's moving so quickly. It was 8% when they wrote that, but it's not anymore.
It is not anymore. I mean, I constantly astonished when I look at my terminal. We're at the highs of the session, and we're still down by nearly 6%. Yes, that is well off the lows. Remember, we triggered that circuit breaker immediately when we opened this morning at the lowest. We were down more than 11%. So now we're looking at losses that are roughly half that, but it's still not a very pretty picture. This is an equity market that clearly isn't very confident that that second emergency cut from the Fed in just 2 weeks is really going to do anything to meaningfully shield the economy from the impact of this coronavirus.
Everybody's blaming the Fed at the moment. Some people are saying they just totally blew it. On the other hand, let me try to defend them just a little bit here. I mean, we had a whole weekend of bad news about the coronavirus coming out. It's not clear that the market wouldn't have been down the limit anyway.
That's absolutely right. I think the thing is sowing the seeds of panic a little bit when you have an emergency full percentage point rate cut just 3 days before a meeting, which is, again, within 2 weeks of already a 50 basis point emergency rate cut. I think to some in the market that looks like a central bank that is in panic mode and that it's bleeding through to investors and traders a bit. Now, obviously, some of that panic we saw earlier in the session, some more rational heads seem to be prevailing as we do move higher here, but I think part of that is the narrative. But you're right, there is still a lot going on aside from monetary policy that can strike some fear into the heart of market participants.
And again, in fairness to the Fed, the markets are saying, give us cuts, give us cuts. So we give them cuts. They say, oh, no, you must be in a panic. At the same time, maybe the market's starting to think about not just the reaction, the sentiment, as it were, to the panic, but rather the underlying merits of what they did, both with the interest rates, but also quantitative easing coming in, dollar swaps. I mean, they really came in a variety of ways.
Well, on the funding stress and liquidity front, this should be very helpful. We have all this talk about a liquidity crunch, a credit crunch, and in many ways that should alleviate some of that pain. I think the broader question is monetary policy going to be enough to alleviate the broader economic pain as we see really an entire country that is shutting down at the moment and all of the ripple effects of that? How much can monetary policy do to really combat that?
And maybe that's the problem, because we all know the answer to that question. Monetary policy by itself will not be enough. It hasn't been enough. It won't be enough. It can keep all the plumbing working so that all the financial markets can function, but it doesn't address the underlying question of, as you say, the economy just grinding to a shocking stop, which is what happened in China, and look what happened there.
Right, exactly. So I think it now becomes a question of, until we see some meaningful fiscal policy coming to this market, there is no real consensus as to when we are going to be able to find a bottom. I was reading notes from equity strategists this morning. Tony Dwyer over at Canaccord Genuity pulled his 2020 S&P target. He said he literally can't model it right now because this market is no longer trading up on fundamentals. It's all about really just human reaction to this crisis. And Lori Calvasina is saying you haven't seen capitulation yet on the part of institutional investors, so you can't call a bottom here. And there's a question of when we're going to get it.
One way of looking at it is we've turned the markets over to the epidemiologists.
Right.
Because really, we have to get some numbers about when are the number of cases going to start leveling off. And until we have that, I'm not sure how we can know how to trade.
Right. This is, at the end of the day, it is a public health issue.
Yes.
And as far as policymakers, there's not a lot that they can really do about it. Yes, the market can react, but until we see kind of a leveling out of cases, seeming that the broader crisis is starting to slow down, I don't think markets are going to really find themselves on a firm footing here.
Okay, Kayleigh, thank you so very much. That's Kayleigh Lyons reporting on the markets. And now we're going to go for First Word News to Ritika Gupta.
Thanks, David. The White House is taking new steps to protect President Trump and his staff during the coronavirus outbreak. That includes taking the temperature of anyone who enters the complex, including visitors and members of the press. Only those with a reading of 99.6 degrees Fahrenheit or less are being allowed inside. And in the press briefing room, certain seats are being left unoccupied to ensure social distancing. For the first time in decades, the Supreme Court has cancelled a courtroom session because of a public health scare. The court has postponed a 2-week argument session that had been set to begin next week because of the coronavirus outbreak. The cases that were on the docket include an $8 billion copyright clash between Alphabet's Google and Oracle, as well as President Trump's challenge to House subpoenas for his financial records. European Union leaders will meet via video conference Tuesday to discuss their efforts to contain the spread of coronavirus, with Italy reporting the most virus cases and deaths anywhere in the world except China. Neighboring countries like Austria and Slovenia have moved to slow traffic. But other nations, including Germany and Poland, have also introduced restrictions. The different approaches are raising concerns that vital medical equipment may be blocked. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. David.
Thanks very much, Ritika. Still ahead, CVS is part of the Private Sector Alliance helping with testing for the coronavirus. CVS Executive Vice President Tom Moriarty joins us to explain what they are doing. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power. I'm David Weston. Friday afternoon, President Trump declared a national emergency because of the coronavirus and laid out a plan for increased testing, relying in part on the private sector. One of those at the White House for the announcement was Thomas Moriarty. He's CVS Executive Vice President and Chief Policy and External Affairs Officer. We welcome him now to Bloomberg for today's conversation in chief, and he comes to us on the telephone. So, Thomas, thank you so much for joining us. Give us a sense, over the weekend, what is CVS doing? How much of this is up and running right now, the testing in your stores?
Well, David, first off, thank you for having me. We believe we're in a unique position to help address the pandemic, given our physical presence. We're working with the administration and other partners to increase frequency and efficiency of the COVID-19 testing. The testing will take place in secure areas of parking lots, not inside stores, and individuals being tested will not have to leave their cars. And we're prepared to activate these sites once FEMA lets us know and has the testing and supplies available for us to use. And we are in constant communication, both at the federal and state level, with all the needed officials to try to affect this testing.
So you need some FEMA support before you can get started. Do you have any indication of when you might get that?
As I said, we're in constant dialogue with them. There's a real focus in getting this up and running, and we're hopeful that we can get started very soon. And we are going to be operating through FEMA and using the resources and logistics that FEMA can provide.
You must be having people show up at your stores and ask for the testing, given what the president said. What are you telling them?
Actually, we have not seen that. I think the messaging has been very clear that this will not be done in the stores. It will be done in select areas of parking lots. And people who are going to be tested will not have to get out of their cars. So we are sending that message, making it very clear. But I think the messaging has been very clear so far to folks that it won't be in the stores. It will be in select areas of a parking lot and at select locations only.
When you're fully up and running, do you have a sense of your throughput capacity? How many people could you handle a day or a week?
We're working through those now with all of the partners who have committed to this, as well as with the resources that both the federal and state government can provide. A lot of focus on how to do this most efficiently and get the broadest reach, and we're going to play our part in that.
Thomas, as a practical matter, a lot of people turn to their CVS pharmacy to actually get some medical advice because they don't have a lot of doctors that they can turn to. More broadly, apart from this testing issue, what is your experience right now at CVS as people coming in, asking for advice, asking for things that might be able to treat the symptoms?
So we have been getting those questions, and if you go to our website, we have instructions and information available. We're constantly updating that. We're constantly updating our pharmacists so they have the necessary information, the most up-to-date information to address this. And you're right, we have some 5 million folks come through our pharmacies each and every day. So having that information ready, available, and being a resource for our customers, that's our focus right now.
CVS also has a rather substantial health insurance facility as you merged with Aetna. How is that affecting that part of your business?
So what we have done, and we've taken a leadership role here, David, in terms of waiving charges for home delivery for prescription medicines. Aetna has waived co-pays for all diagnostic testing for the COVID-19 test. And through Aetna's Better Healing program, members who are diagnosed with COVID-19 will receive a care package containing CVS over-the-counter medications to help relieve symptoms, as well as personal and household cleaning supplies to help others in the home protected from potential exposure. So this really is a total company effort here across all of our businesses.
Okay, thank you so very much. Really appreciate it, Thomas. That's Thomas Moriarty. He's CVS Executive Vice President. Almost every state now has been hit by the coronavirus, and that certainly includes my home state of Michigan. Welcome now Representative Haley Stevens, a Democrat who represents a district just outside on the outskirts of Detroit. And she's here actually coming to us in person. That's great. I thought you might be on the telephone. Representative, thank you for being with us. First of all, give us a sense of your home district. To what extent has the coronavirus affected your constituents?
Hi, David. Great to be with you here. Look, Michiganders are doing what we do best, which is we're hunkering down. We're committed to the steady fortitude of everything that has kept us strong as a state through many different challenges that we've faced over different periods of time. If it was World War II, where we stood up to meet the challenge of the time, to the Great Recession of 2008, 2009, we've obviously since rebounded from there. There's a lot of questions on everyone's mind. Make no mistake about that. Society and ways of life are temporarily changing. Restaurants are scaling back, consumers are scaling back, and you're starting to feel that immediately right now. I spent my weekend fielding phone calls, talking with economists, talking with health experts, and here we are today. But we are going to manage through this situation on the health front and on the economic front, and nobody will be left behind. And give us a sense, Congresswoman, of exactly what's been done in the state of Michigan. I saw a report that your governor has said that as of, I think, 3 o'clock this afternoon Eastern time, you're going to be shutting down restaurants and bars, at least for going in and eating in the location as opposed to pickup and things like that. What's going on with restaurants, bars? What's going on with schools? To what extent have you shut down? Yeah, our governor has taken swift and immediate action. She's been an exceptional leader. This morning we were notified that restaurants and bars would be closing at 3 p.m. Some are allowed to stay open for delivery as well as pickup services. Up to 5 people can be in restaurants just with 6 feet apart. And this is obviously going to have a lot of impact. Schools were closed last week for a several-week period. Lots of families are managing through that. A lot of my incredible schools have immediately stepped up to continue to offer meals and assistance. In Birmingham, Michigan, for instance, they're offering meals to any child, whether they live in Birmingham or not. So very, very important here that we're coming together as a community. And certainly being a manufacturing hub, this is also on people's minds in terms of keeping our factories open, keeping the supply chain going, but also maintaining the health of every individual. So you saw the UAW and the Big Three form a task force this weekend. That was some communication that we had over the weekend as well. And we're managing this day by day. We're taking into account, particularly at the federal level, though, the health considerations as well as the economic considerations. They're inextricable.
Okay, Congressman, one last question, if I could. You also have expertise on bailouts because you worked on the auto industry bailout. What would you give advice to your fellow congresswoman and congressmen up on Capitol Hill in terms of some of the industries that need help right now?
Sure. So the economic imperatives are manifold. One, we've got to address the immediate and financial pain that individuals are feeling. Small businesses, mom and pop shops who employ many of these individuals who also have to make rent. And we have to secure state and municipal governments to make sure that they continue to have the revenues to run effectively. As it comes to large industries that are essential to our country, aero, auto, energy, ag. We've got to make sure that those are also secure. And so the conversations that we're having around cash, liquidity, credit, all options are certainly on the table, but the companies are taking the steps right now. We're seeing this with the airlines. They're experiencing similar to what auto did. Largest drop in the history of the airline industry. Unbelievable figures. $1 billion slashed year over year. Companies are taking steps shoring up executive pay, securing credit lines, and we're obviously monitoring that process. But first and foremost, we've got to ensure the financial security of every American in this period of time. That is what I'm advocating for in Congress, and that is my commitment to Michigan.
Okay, thank you so much, Congresswoman. Really appreciate you joining us. That's Representative Haley Stevens of Michigan. And now for today's Wall Street Week update, we welcome Larry Summers. He's former Secretary of the Treasury and Bloomberg contributor. He comes to us today by way of Skype. So, Larry, thank you so much for joining us. First of all, let's get your reaction to that emergency Fed rate cut of 100 basis points yesterday. Was it the right thing to do? Did they make a mistake? Some people on Wall Street are saying they blew it.
All things considered, they didn't have many choices, but it was playing defense against the problem and the expectations that had been created, and it was playing defense with a very weak policy instrument. You know, monetary policy doesn't get people out of quarantines. Lower interest rates don't cause people to go out when they're scared they're going to get a disease if they go out. So, yes, they did a reasonable thing, but we've got a deep, real problem that is causing output to go down. And insofar as there are aspects of it that can be fixed, they probably can't mostly be fixed with monetary policy. So I think the Fed did the job that was there for it to do, but it wasn't a large one.
So Larry, we're clearly confronting something that none of us have seen before in our lifetime, and this is globally. What should we be thinking about that you've not heard suggested? Because this is going to require some big and probably very innovative set of solutions.
Well, I think we need to manage our expectations realistically, which not everybody's doing. Perhaps the best metaphor I've heard for our current situation is that we're basically putting the economy into a coma in order to solve the contagion from coronavirus problem. And therefore, we can't be demanding that it be fully conscious and fully functional, since it's the essence of what we're trying to do, that there be less commercial interaction. I think what needs to get more attention than it has already is all the various money flows and debt obligation flows that continue to accumulate, even if the stores are closed, even if there aren't opportunities to go shopping, and how we're going to work out all those accumulating debts, the lease payments of the owner of a small dress shop, the obligations against a credit revolver of a restaurateur, the obligations to workers and suppliers of a small manufacturer, those obligations of the people who worked in that restaurant to pay their installment payment to the local furniture store. All these interlocking webs of debt we're going to need to find a way to manage through. And my hope would be that we can find better ways than standard bankruptcy and resolution procedures. Just how possible that will be, I don't know, but providing liquidity so this doesn't need to be any more damaging than is necessary to contain the disease is, I think, where the policy discussion needs to turn.
Beyond trying to minimize the damage, are there things we can do to make sure the patient comes out of the coma in reasonably good shape?
Yeah, we need to have a set of robust and ready-to-go public investment programs when people can be interacting again to fix all the deferred maintenance that we have coming out of this. We need to take advantage of this opportunity to create a renaissance in the use of computers and information technology in education. We have a historic opportunity to experiment and to innovate with technologies that will let people attend school and be educated outside of a classroom. Let's take advantage of those things.
Okay, great, Larry. I'm going to interrupt you only because we have Larry Kudlow, your successor, who's right now appearing at the White House. Many thanks to former Treasury Secretary Larry Summers. Now let's go to the White House and listen to Larry Kudlow.
To see what works, and of course the Treasury Department and the Fed have enormous powers on this. So I see it as a liquidity fix, not a bailout.
Is $50 billion about right? Yes, Larry. Would you argue with some of the top economists in the world who are now saying that we're entering a global recession?
There's a lot of forecasts out there, and I appreciate that, respect that. We are going to be challenged, with no question about it. We are going to be challenged. I've been saying that, and I'll continue to say it. I'm not going to label it one thing or another. We just don't know. The models don't know. There's a lot we don't know. First quarter is going to be fine. It's the second quarter. I understand that. It'll be a very difficult quarter, but I don't need to have labels on this. We'll take it one step. Again, this is the key point that if you just allow me a moment. For some reason, some friends of ours have written in, prominent people, that we haven't done anything fiscally. And that's just all the Fed. It's just not true. So, and the president has said in his speech Wednesday night and again on his presser on Friday, I'll say it again, we have roughly $400 billion in, I prefer to think of it as fiscal assistance. And one of them is in the bill that got through the House. Obviously, the unpaid sick leave and all that goes with that. That's one. Second one is enormous support for small and medium-sized businesses, which will be made larger because of the declaration of the Emergency Stafford Act, which allows us to draw a lot of funds from FEMA, for example, as well as the SBA. Another is the deferral of the income tax for businesses and individuals for 3 months. That's penalty-free, interest rate penalty-free.
We've been listening to Larry Kudlow, the chief economic advisor to President Trump at the White House. We will continue to monitor that and bring you any headlines that come. In the meantime, we want to turn to Scandinavia. Scandinavian Airlines SAS is halting most of its flight. The company is also temporarily suspending 10,000 staff. We're joined now by CEO Rikard Gustafsson on the telephone. So, Mr. Gustafson, thank you so much for joining us. Tell us about what you did today and why you needed to do it.
Well, we noticed that the governments in Scandinavia, they have acted in an unprecedented way. The state of Denmark, they closed its borders. State of Norway closed its borders. And the Foreign State Department in Sweden, they recommend people not to travel to any country on the globe. And of course, that means that the need and demand for air services actually dried up. And we had to cope and then adopt to a new paradigm and a new reality. And that's why, unfortunately, yesterday we announced that we will pause most of our operation from today. And also we needed to reduce our workforce significantly to adopt also to that revenue-generating part of our network that is now gone. So therefore, we had to send home 10,000 of our people, or close to 90% of our workforce, on a temporary kind of layoff. The intention, though, is not that we go to permanent layoffs. We hope that once we're through this, we will get back our valued and skilled employees, so we can get back up and return to normal operations again. But the fact is that is no real demand for air services anymore, and we have to act accordingly.
So, Mr. Gustafson, obviously, the first concern is with the safety of people and their well-being. The second, of course, is with the economy. But we also have to be thinking about your company. Give us a sense about your finances. Given where you are right now, how long can you sustain this without some sort of state aid?
Well, it's a question I can't give a straight answer to. I'm very happy, though, or pleased that for many years we have had a significant focus in our business to retain a strong financial preparedness and a good liquidity. And that's where we stand, and that's where we start. And so that will help us. But, of course, it won't last forever. And if this situation drags out and continues to this extreme extent, also way into the summer, I think not just SAS, but all of European aviation will be in significant troubles.
Yeah, there's a consultancy based in Sydney that I'm sure you've heard of, the Center for Aviation, and they came out with a statement that said that most airlines globally will be bankrupt by May if there isn't some sort of state assistance. Does that sound plausible to you?
Well, I can't say by May, but I do agree if this continues, and again, especially for European carriers, if I may speak for them in particular, we are extremely dependent on the summer season. That's the high season for us. That's when we generate the returns for the full year. And if that is not going to happen this year, we will all face serious troubles, and SAS is no extent.
Okay, thank you so much. Really appreciate you joining us. That's SAS CEO Rickard Gustafson. Coming up on Bloomberg Radio, we're going to continue the conversation on the coronavirus. This is Balance of Power, and we are on Bloomberg Television.